Well, for more on Powell's testimony and the U.S. economy overall, I'm joined now by Ray Locker. He's the Washington Enterprise Editor at USA Today. Welcome to the show.
Hey, thanks for having me, Rachelle.
So let's start with your take on Jerome Powell's testimony, his performance, and really the tone that he's setting for the central bank.
Well, there was a lot of continuity there. I mean, he's been on the Fed board before. He's close to Janet Yellen, so people assumed that this was what they would see when he testified today. And his performance so far in office has, borne that out.
Now, we've certainly seen with Yellen's testimony, we always heard the word gradual. Powell seemed a lot more optimistic. In terms of the pace for his rate hikes versus, say, Janet Yellen's, what are the expectations then?
Well, he mentioned he didn't want to prejudge things, but we're looking at probably 4 rate hikes this year instead of 3. That's a little faster pace. But I think that's, indicated by the changes we've seen in the economy. Huge tax cut, big spending bill that came last month. So those two in combination are going to, really rev up the economy faster than what some people had anticipated.
And do you think there'll be any significant differences from what we saw under Yellen? Anything different? Because a lot of people have been saying it'll be more of the same. Any differences you see?
Well, maybe in terms of the pace of a rate increase. And I think that's borne out by whatever kind of economic indicators, we see. And she might have done the same thing if she had been in there and presided over the tax cut and the spending bill.
Now, let's also look at this balancing act that he has to do. You have historically low unemployment. He also has to manage inflation, roll out these rate hikes, try not to, royal Wall Street too much, while still keeping the economy growing. How will he manage to do this?
Well, it's a tough job. I mean, if we go into an inflationary cycle, he's going to have to raise rates higher. That'll slow things down. We saw that in the wake of the tax cut with the market correction when it went down about 10%, because people are worried now. If they raise interest rates, is that a more, better place to put your money as opposed to stocks? And if we see continued rate increases, more and more people may feel that way and go that way or to bonds and away from stocks.
Now, as we did see those very wild swings with Wall Street, we saw the decline, it's a slight comeback. Right. Now, Powell actually shrugged off this volatility, saying it was pretty much par for the course. And it said that it didn't really have a wider implication for the economy. What's your take on that?
Well, I think that's true. I mean, most economic experts say the stock market is not the economy. They're basically two different things. And sometimes when the economy is doing great, the market doesn't do as well because investors worry about different things than most people who are not invested in the market. So I think he's right on that.
And how would you characterize the current state of the U.S. economy in terms of its strengths and some potential headwinds that we should be looking for?
Well, I think it is a strong economy. We're down to basically, peak employment, 4.1% unemployment. That's really good. Now we're starting to see some wage growth accompany that, and that is where you get the problems. Are you going to enter an inflationary period? Now they're looking at between 1.7 and 2% a year. That's really good. Historically, I mean, that's been great. But if the tax cuts come in and more money starts sloshing around in ways that people hadn't anticipated, it could be a problem.
And speaking of these historic tax cuts that we saw, how much impact is that having so far on the economy, and what should we expect in the near future?
Well, I think most people aren't really noticing the effect in their paychecks. You're seeing it in corporate America. They're getting more money. I think Berkshire Hathaway, Warren Buffett's company, said they got an extra $29 billion because of this tax cut. Now, where does that money go? Do they buy other companies? Do they, buy back stock? Do they pay out more bonuses or dividends? It's hard to tell. But if that money starts creeping its way into the economy, it could, spur inflation.
Now, let's talk the actual short-staffedness that we're seeing at the Fed. We know that only 3 of the 7 Fed governor positions are actually filled at the moment. How much will that impact the effectiveness of the Fed going forward?
Well, the Fed is a large agency, and it has, thousands of people who do business there. So, by and large, these vacancies probably won't have a huge effect. But when you get to the actual policy-making decisions, it's good to have a full complement of people there who are ready to deal with the high level of decisions that a subordinate can't make. And we're seeing this as an issue throughout the Trump administration as a whole. I mean, USA Today had a story today that says 41 ambassador slots have not been filled. And so if you don't have people in those jobs, it's hard to have kind of any kind of long-term strategic thinking or continuity because the key people aren't there to make those decisions.
So given that, just quickly, what's your outlook for the U.S. economy going forward?
Well, I'm not an economist, but from what I can glean from people we've talked to, it's, looks very good. The downside is whether there's too much money in the economy and whether that causes too fast of an interest rate increase that causes problems in the stock market. And that could be a problem if people sense that they don't have as much money, mentally as they thought they did, and then they start curtailing their spending and investment.
Certainly a lot of behavioral economics involved there.
Absolutely.
Thank you so much. Ray Locker there of USA Today.